we're now going to look at the particular case of where we value a property for insurance purposes. Now, insurance purposes is a very specific reason for valuation. It doesn't have to do with the value of the property as such. It is usually associated with the value of the improvements, and of the improvements usually the value of the most significant improvement, say the house for a residential property or a shop or a commercial building for something else. Usually we're not interested in minor improvements, ancillary improvements such as landscaping in the backyard or a side fence or something. First of all, they're usually not valuable enough to bother insuring, and secondly, they're quite a separate event very often. If a house burns down, the pool is probably not going to be affected, things like that. And so we're valuing particular improvements, and so that focus helps us to understand why the land value is not taken into account. To get the values, basically we're going to be looking at our best estimate of the cost to replace or reinstate, depending on the nature of the policy. And that can be taken, like other applications of the cost method, from either our familiarity, our professional familiarity with the industry. We might know the building industry in our locality for a particular type of building. If we don't have that kind of insider information and familiarity, we'll probably go to Cordell's or Rawlinson's to get a standard construction cost indication. As we mentioned in the notes, the use of Cordell's or Rawlinson's is fine because you can stand up in court, point to a page in Rawlinson's, and the judge won't take it any further. However, those numbers are not necessarily precise for any particular situation, and the further you get out of a capital city or into more specialised buildings, the more likely the standard published guides are going to be at variance, either a little bit higher or a little bit lower than the local cost to construct. So understanding your local circumstances is, like everything else, the mark of a really experienced valuer. However, we're going to be working on Rawlinson's. The other complication with insurance valuation is that we have to take into account time. We're going to be looking at 3 periods of time primarily that we need to consider. We can consider some others as well. The 3 periods are, first of all, the length of time that the valuation is going to be valid for. And so normally a valuation will be considered as valid for 3 months. And so if the price to replace the building is going to increase over that time as a result of strong inflation or changes in building costs or what have you, we'll have to take into account that. So if it's worth $1 million today, but let's say in 3 months' time to replace the same building, it might be an extra $50,000 or something, then we need to specify the higher number rather than the lower number, because the insurance company does not want to underinsure. Likewise, the insurance policy is going to run for some period of time, and so it could be that the event, the fire, burning down the building, what have you, might happen on the last day of the policy. And so again, if the building is worth a particular amount at the first day of the policy, but during the life of the policy it goes up by 10%, then the insurance company wants the building's value at the end of the period, not at the beginning of the period. So our $1 million property has gone up by $50,000 over the 3 months of the validity of the valuation. It might have gone up by $100,000 over the 12 months that the policy is running, and so that's 2 periods of time. But the last one is that, let's imagine that the building falls down or is blown up or whatever happens to it on the last day of the policy. It might take some time for the reconstruction to begin. By the time the dust clears and the new dimensions, the architect's designs and the preliminaries and all the rest of it are done, it might take you a few months between when the building is destroyed and when the reconstruction begins. So that's another period of time that has to be accounted for, because the insurance company needs to be able to cover the reconstruction of the building at the time when the reconstruction is being done. And lastly, of course, if it's a complex building, it might take some period of time. It might take 12 months to rebuild it. It might take more. And during which time, if building prices are increasing, then you need to take that into account. Basically what I'm saying is we have to take into account time value of money, and we have to be shrewd about what periods we're going to be dealing with. But basically the mathematics is very simple. We work out a cost to construct based on Rawlinson's or some other estimate, maybe our own understanding, and then we adjust that by time. We're only interested in the improvements, we're not interested in the land. Okay, that's the theory of it. Let's look at how that pans out in the self-correcting exercise. This is a fairly typical exercise, and if you can do that, you can do any of these insurance type calculations.
This calculation is pretty straightforward. First thing we need to do is look at the total construction cost. And so here in our case we'll say that we've got a construction cost that we're writing in as $1,300 per square metre. We're also going to add a amount for demolition and rubbish removal and so on, and so we'll work that in this case on $50 per square metre. These numbers can come from Rawlinson's, Cordell's, some construction cost guide, or they can come from your familiarity with the industry, which is actually superior but a little bit harder to justify in the courtroom. So which one do you choose? Well, that's up to you. Depends on the job largely. Okay, important though to remember to add the demolition amount. Now these numbers can be constructed in other ways. Here we're simply using a gross cost per square metre, which is a nice ballpark approach. That's fairly reasonable, and it's what the industry often works on. You can go to more detail, break this out into trades and so on, the same as for other applications of the cost approach. However, we're not bothering with that. So while this is a back of the envelope type of calculation, it's about as far as most people go, most valuers go, but just be aware that this number could have more science behind it if necessary, if it was considered the job warranted it. Likewise, the demolition figure, that's something you'll find from Rawlinson's, but you may have a better idea of what the local demolition contractors are charging, and so you use that number. Okay, so here we've got 2 rates per square metre, so obviously to both demolish and construct, we're simply going to add the 2 together, so that's fairly easy. We've got $1,350 to remove the old improvements, the damaged things, and to build new ones. We've got 170 square metres of floor area, so we simply multiply one by the other. Okay, that's the estimated construction cost, the building value at this point in time. Now we take into account also now our time delays, our cost escalations, as we mentioned earlier. Here are the list of the likely delays. So we're talking about an initial delay of 3 months. That's fairly normal because your valuation is considered to be valid for 3 months. You'll have a 12-month policy. You'll have maybe 6 months to the point where you actually start construction. And here we've got an optional area. You'll notice that I put a note in the model just to remind you that the half construction period is a normal part of this calculation. However, it's not always relevant. It's not relevant where you've got a situation where the construction period is going to be relatively short, or if the likely contract arrangement, if it's likely to be worked out on a tender basis, because the tender will give you a fixed price at the beginning of the construction, which will not change. And so this is a optional entry, and we simply haven't bothered to put any numbers in here. However, it doesn't really matter because whether we do or not, because all we have to do really is add up these numbers. So it's fairly simple. We're going to do that using the sigma key, a little bit of a shortcut. So it tells us that there's basically a matter of 21 months. We're going to divide that by 12 to get down to years. And so there could be up to 1.75, 1 3/4 years in this particular case, between when the valuation is done and when the construction has to be paid for, at least when you commit to some sort of a price. If the construction costs are growing at a rate of 4% per annum, what it means is we need to increase our figure up here by that 4% over the delay period. And we do that using this little formula here, 1 plus g raised to the d. That's simply a compounding formula, the familiar finance factor that we put in for the time value of money or for the escalation or inflation effects. All of those things use the same expression, which we need to be very familiar with. So let's put it in now. What we're going to be doing is taking the estimated building cost, building value, and we're going to multiply that by 1 plus the growth rate raised to the weight, the delay, and so that gives us $245,000. So we've added about an extra $20,000 roughly, about 10% as a result of the delays. That's the important aspect. The next consideration is we're going to add in those other costs which are above the minimum construction cost. So on top of the actual construction cost, which we've worked out is going to be something like $245,000, we also have those other ancillary costs, things like architects and engineers fees. We're going to have statutory fees for getting building approval and so on. So an estimate for those needs to be worked out. These are being worked out as a percentage of the construction cost. Here we've got a value of 245, so we're simply going to be adding these fees. Now we can work those out individually. It is not an absolutely precise calculation, but it's as useful an estimate as we need. So here what we're going to do is take the reinstatement insurance value, which is really the total building cost. We're going to multiply that by the 12% for our estimate of professional fees. We're going to do a similar thing for the statutory fees. Same calculation, simply multiplying it together. What we're going to do now is add these fees, these extra costs, to the construction costs. We can use the sigma function as long as we adjust the scope of it sufficiently, or we can use simple addition. Now we're going to take that figure, rather than pretend that we know the number down to the individual dollar, we're going to round that. We'll round it to the nearest 1,000. Probably rounding it to the nearest 10,000 would be at least as appropriate, and probably more prudent. However, people understand things down to thousands and no one's going to complain. So we'll put it around -3, which gives us -3 decimal places, or brings it up to 288,000 in this case. It could be 290,000 without any problem at all. So the amount of rounding you do is a matter of prudence for yourself. Okay, that's the basic reinstatement. So that will replace new for old, taking into account the passage of time between when the valuation is done and when the tender is actually made. We now move along to looking at the indemnity value. Now the indemnity value is the replacement of the improvements at about the same level as they were originally. This is less common because it's more convenient usually to replace new for old, but you can insure some cases for indemnity, which is to give you back the building in the same condition or the same standard as it was. In this case, the indemnity value really is insuring for the present value of the building rather than its replacement value. Here we're going to be applying a depreciation. We've worked out previously how to work out depreciation rates. We can do that by examining comparable buildings, comparable sales. We're not going to concern ourselves too much with how we work out the depreciation at this point. We'll just say that we're estimated we've got 30% depreciation. So what we're going to be doing is taking the insurance value that we calculated above, and we're simply going to be multiplying that by 1 minus the 30%, because we're saying that we're actually insuring 70% in this case of the new for old insurance value. Again, we're going to round that, and so we use the round function. We could do this by hand, and here we'll take our value and then we'll round it again to the nearest 1,000. So that'll be -3, close brackets. That gives us about 201,000. So in one case we're insuring for 288,000 for the new for old insurance policy. Here we're only insuring for 200,000 in the circumstance where we really only want to insure the value for its current worth. That's all there is to it.